Thanks everyone who joined us today. Welcome to 2026. It's going to be an interesting year, and Yvonne and I are here to speak a little bit about what's coming, not necessarily a crystal ball, but what we know of. And obviously, through the year, things will be changing. All right. So for those of you who don't know me, my name is Tetiana George. I'm the CEO of Curium, a technology platform that helps people with their risk compliance and claims. And Yvonne, she's a partner at Clyde Co. She specializes in corporate insurance and regulatory law. I'm sure you've seen us before or heard about us before. If not, great to meet you. All right. So there are 5 big topics on our agenda today. First, we'll start with a very, very brief recap of 2025, kind of high level, what happened, what were the big kind of seismic shift changes in the regulatory landscape. Then we'll go into ASIC's regulatory priorities for the next 2 years. Then we just wanted to touch briefly on our observations of what's happening with CPS 230 in the market and how it's actually playing out. Then we will do a brief review of 3 codes, so the industry codes, the ICA code, the NEBA, and the CALI codes. And finally, finish up with some practical tips of what we think the changes will be for different parts of the business, but also if we think there's something you can start doing now, we'll share our considerations. Perfect. So let's start with recap of 2025. It was a big year for APRA, I would say. There were 2 major changes or introduction of new regimes. One is Financial Accountability Regime, FAR, and the other one is CPS 230, Operational Risk Management 1. So for the first one, Financial Accountability Regime, it touched only the APRA-regulated entities, as you all know. So, and it happened fairly early in the year. So we had 3/4 of a year to adjust. The CPS 230 happened mid-year, and as you all know, it touched a very, very wide scope of firms, irrespective of their APRA license status. And a lot of those firms are specifically underwriting agencies, lots and lots of technology firms, and third-party claims administrators and other suppliers. So this was quite big, and that's why we even reserved a section to speak about it a little bit. What else happened is the quality of advice review, so tranche 1 on informed consent and commissions, and better retirement outcomes. So we have probably been to many, many events and webinars and so on about it last year, so we won't keep dwelling on it. It happened. Then mandatory climate risk reporting. Again, it probably has not touched the smaller players in the industry, but it has definitely touched the large ones, and they've got staggered approach to this in terms of their size. So the different start of this legislation depends on effectively the size of the business. And so the very big ones, they're already in the new mandatory climate risk reporting regime. And finally, the privacy reform happened in June 2025. It was, again, the first tranche of it. There were some changes to the powers of the OAIC and some changes to how firms are supposed to disclose the use of technology, especially in the decision-making that relates to the customer. But those changes will only be effective from late this year, 2026, so November 2026. We will have a separate webinar on the privacy, so just look out for a new email from us. All right. Now I pass on to Yvonne to give you the update on ASIC and the regulatory grid.
Thanks very much, Tetiana. So thank you for the recap of everything that happened in 2025, the big ticket items. Looking ahead, we get a bit of a forecast and a preview of what ASIC will be considering and focusing their attention on in terms of documents through the Regulatory Initiatives Grid, which is coordinated by the Australian Treasury, and the different regulatory reform initiatives that will touch on ASIC, APRA, other agencies. But we can see from the forecast over the next 18 months, ASIC is really focusing on revamping the various regulatory guides that set out their regulatory expectations for Australian financial services licence holders. And they've already started reissuing some of these guides following some consultation in 2025, the first of which is Regulatory Guide 168 on product disclosure statements. We've taken a quick look at that. That one was reissued on the 3rd of December. They looked to update this guide to really simplify the regulatory complexity in this space. It used to be a guide that touched on other types of disclosure documents such as financial services guides, but ASIC in their update has decided to really just focus on PDSs. They've moved most of the information that they had on guidance in relation to FSGs into a separate information sheet. So it all sits in information sheet 291 in relation to FSGs. So this regulatory guide 168 now is a bit of a one-stop shop for all ASIC guidance in relation to PDSs only. Now, the part of this shift in focus for ASIC in concentrating all that information into Regulatory Guide 168 is really to provide some additional guidance on compliance risks and the consequences when PDS requirements are not met. So the underlying legislation, which is legally binding, hasn't changed, but it's what ASIC expects from regulated entities and how they think regulated entities should take steps to make sure they do continue complying with those requirements. That's shifted in this guide, and there's a lot more examples now as to where they consider certain content in PDSs might be considered to be misleading and deceptive. Key focus areas for that, if you're making any statements about future matters or comparisons, ASIC's now provided a lot more suggestions about how to minimise the risk of that occurring. So it's definitely worth looking at that in more detail. Other updates to Regulatory Guide 168 specifically address the insurance sector. So there's now specific guidance on circumstances where a PDS might not be required for general insurance products. And there's an example where RG 168 now advises that a PDS doesn't need to be given where you're making an offer to issue or a quote for a general insurance product where you have solicited contact over a phone call with the client. If you make sure that on that call you provide some clear, concise information about any exclusions and limitations that apply to the product, and that those details can be found in your PDS. And also that the level of insurance cover under the product might be a bit different from other general insurance products. So it's practical things like that where you might want to revisit your existing processes, and perhaps if you use phone scripts, you might want to take a look at examples and further guidance ASIC's now included for the sector. Now, moving forward, we've also had another large regulatory guide 181 on managing conflicts of interest, which has been published on the 16th of December. So this is a guide that was last updated in 2004. And the purpose of this update was really for ASIC to align it with developments in law and policy. The obligation that this comes back to is set out in section 912A 1AA of the Corporations Act, and it's the conflicts management obligation that requires licensees to have robust arrangements and conflict management strategies in place. So as a recap, that obligation requires you to have adequate conflict management arrangements that manage any conflicts that could arise wholly or partially in relation to any activities that you might undertake in the course of providing financial services. And it doesn't require you to eliminate all conflicts of interest, but you do need to have processes in place to adequately and effectively manage all those conflicts of interest you do identify. And you can do that through having control mechanisms and making sure that you have adequate disclosures. So ASIC, in updating this Regulatory Guide 181, they've provided a lot more guidance around how the law applies to the conflict of interest and how it interacts with other obligations that you might have, whether it's those general obligations that sit in section 912A of the Corporations Act or other obligations that arise from dealing with retail clients and providing personal advice and things like that, which all sits now in a bit of a catalogue at the back of the new reissued RG 181. And they also emphasise that there should be certain arrangements in place, and they've put together a more practical guide of the expectation of various steps they expect licensees to have to demonstrate that they have adequate conflict management strategies. So the practical steps they expect you to have is ways to identify, assess, and respond to conflicts, and also arrangements in place for you to implement, monitor, maintain, and continue reviewing that those arrangements are adequate for your business. So worth looking at that. Now, in terms of practical effect for this updated regulatory guide, there are actually quite a few examples that they draw out in relation to conflicts of interest that insurance brokers may have. So they include a couple of examples that they consider would constitute a conflict situation. So one is where an insurance broker might be influenced by financial interests. So they might recommend to a client that a product that generates higher commission over a product with similar coverage that results in lower commission for them. That would be a conflict situation from ASIC's perspective, given it might be dependent on the commission, the level of commission that the brokers receive. They also draw out a potential conflict of duties situation where an insurance broker could be influenced by financial interest that arises from any cross ownership or shareholdings between the broker or the broker's corporate group if they belong to a broader network, and if there's an insurer or underwriting agency that it places business with. So those recommended policies that might be placed could potentially benefit a related insurer or related underwriting agency, rather than the recommendation to the client being for a particular product that might be most suitable for the client. So ASIC's indicated in that guidance that situation would constitute a conflict of duties that could give rise to a conflict of interest depending on the situation there. I'll just briefly touch on the other guides that we've got listed on the slide there, but they're less relevant to some of the day-to-day operations. RG 183 has also been reissued. That's the one on approval of financial sector codes of conduct. That's more relevant if you were seeking to get a code of conduct updated and then approved by ASIC. It will become relevant for some of those who are involved possibly through one of the industry bodies in the section that Tetiana and I will take you through later in this webinar on the various industry codes for general insurance, life insurance, and broker code of conduct that will be updated in the future, but less relevant on a day-to-day level for that. There's also RG 221, which is on digital disclosure statements and other obligations, which was also reissued on the 3rd of December. And lastly, RG 53 and RG 234, which relate to the use of past performance and promotional material and the advertising of financial products and services. Those are due to be published in April to June this year. So there's a current consultation process that's underway for the update of those regulatory guides, which will have quite a big impact, I think, on the way that the financial sector advertises financial products through various channels, including through websites and other means. So yeah, look forward to seeing that, and we'll probably have separate webinars once we see the content of what that regulatory guide looks like once it's been reissued. And then lastly, just a note to touch on the point that Tetiana raised earlier about the mandatory climate-related risks reporting regime, which came in for large Group 1 entities last year. ASIC has flagged that they will be due to commence the first round of reviews for those reports that came through for the Group 1 entities. They will also be looking that's in advance of the second group of entities due to report from the 1st of July 2026 onwards. So I'll take you through shortly a bit more what ASIC intends to do in that space for anyone who's caught within that particular reporting regime. Might move to the next slide. So in relation to ASIC as a regulator beyond those regulatory guides and the mandatory climate risk reporting regime that we just touched on, ASIC has some various overarching strategic priorities that they set for the years ahead from 2025 to 2026, but also beyond into 2029. Now, the slides just set out 3 of the key strategic priorities that ASIC has indicated they will continue to focus on that we think are particularly relevant to the insurance sector. But we need to bear in mind that these strategic priorities are in addition to the enduring priorities of ASIC, which include focusing on misconduct that has a high risk of significant consumer harm, particularly for vulnerable customers. They will continue to look at systemic compliance failures by large financial institutions. They will be monitoring any new or emerging conduct risks within the financial system broadly, and also will be looking at governance and directors' duty failures on the whole. And all of this was reconfirmed this week, 27th of January, when ASIC came back from the Australia Day break and released a key issues for 2026, which just reiterates that these are the strategic priorities and focus areas for the regulator in the year ahead. So the first set of strategic priorities relate to the improvement of consumer outcomes. And for the insurance sector, this means that ASIC's going to be really focusing on licensee compliance with their obligations to report on complaints received. Now, this is talking about your internal dispute resolution processes and outcomes under RG 271 if you are doing retail business. And they will continue to publish any IDR-related data that's recorded by licensees. And going forward, this will now be at a firm level rather than at an industry trends level. So quite important as a shift following some consultation last year on the level of granularity of data that will be included going forward. The second area is on general insurance premium disclosures. So ASIC is looking at the accuracy and the transparency on any general insurance disclosures about premiums, and then looking to explore consumer experiences in that context. They will also be looking closely at claims, so cash settlement practices in particular. They will be looking at how general insurers offer and disclose any cash settlements and whether there are any risks of consumer harm in that process. That is particularly relevant now in the light of recent disasters in Victoria and Queensland in relation to extreme weather events. ASIC this week has reconfirmed that they'll be looking at any instances of poor insurance claims handling, which can arise when insurers are suffering from a high volume of insurance claims coming through as a result of these weather events. And they're really focused on making sure that poor consumer outcomes in relation to delays, errors, and poor communications don't arise in that context, particularly because they've also commenced court proceedings against general insurers recently in relation to serious claim handling failures, and look to continue to hold the sector to account. Now, on the second area, strengthening of market disclosure and conduct, this goes back to the mandatory climate risk reporting regime that we mentioned earlier. It's also known as sustainability reporting and impacts different companies that are required to produce annual financial reports under the Corporations Act. So if you're caught by the corporate size threshold, the emissions threshold, or value of assets threshold within Group 1, 2, or 3, then on a staged process over the next few years, you'll be required to start reporting any mandatory climate-related risks in those sustainability reports. And as we said, the first group already started reporting from the 1st of January 2025, and there are more groups. Second group will be due to report for the financial year commencing 1st of July 2026, and then Group 3, 1st of July 2027. So in that context, ASIC's already starting to look at the reports that were submitted by Group 1, but they're also very aware that as the regime expands, there's also risks of misleading and deceptive or incomplete disclosures being made by entities going forward. So as a result of that, they're looking to ramp up enforcement action on greenwashing. That could be the other side of the coin of inadequate disclosures in that space. Lastly, they are also focusing on directors and officers in terms of conflict management reviews. So this is different from the reissued RG 181 for conflict management in the context of being a licensed entity. ASIC's looking at conflicts of interest that directors and officers might have at the level of board and senior management within companies, and they'll be looking to report on good and poor practices that they observe in that space. Now, lastly, the strengthening of digital, data, and operational resilience. So that, in a nutshell, relates to ASIC's focus on licensees who use offshore service providers. They're quite concerned about data sharing and privacy risks that could arise from the use of offshore service providers, particularly where they're operating in investment management or financial advice sectors. On the other side, even generally, even if you don't outsource to offshore providers, ASIC's really concerned about the increasing cyber risks and operational risks where it's getting driven by, various technologies being incorporated into businesses, and just general incidences of cyber incidents rising over time and scams proliferating through the financial services system. So in that context, they're looking to take enforcement action if they see regulated entities that are not taking appropriate action on cyber and operational resilience, and particularly in relation to poor use of AI. So ASIC's starting to see harm and risks that could be suffered by consumers as automated decisions, AI-driven interactions start becoming embedded into business models within the Australian financial system. And back in 2024, they've already started looking at licensees who have chosen to adopt AI in their organisations, and they've already noticed that there's different levels of maturity in how they manage the AI governance of risks that arise from the adoption of AI. So from 2024, they've already signalled that they expect AFS licensees who choose to adopt AI need to make sure that the risk governance frameworks evolve and don't lag behind the adoption of that AI within their business, to make sure that they continue to comply with the technology neutral laws relating to compliance for financial services licensees, regardless of what technology they choose to use for that compliance. And for the year ahead, ASIC's going to be working with a newly established AI Safety Institute, AC, which the federal government has decided will become an institute that monitors, tests and shares information on emerging AI capabilities. There was some consultation in the past couple of years about potentially moving towards a mandatory guardrails model for high risk use cases for AI. That's been put on hold while the Institute works with existing regulators like ASIC, like APRA, to identify if there are particular legislative gaps in relation to those technology neutral financial services frameworks, to see if any standalone AI legislation might be needed in the future, or whether the mandatory guardrails approach should be picked up and developed further. So this is a watch this space kind of area as we see how it evolves and the regulators start working together with that institute to see how those frameworks respond. There's also quite a focus from ASIC on legacy systems, digitisation, and that reliance on third parties. ASIC is really now urging directors and licence holders to make sure that they do maintain robust risk management frameworks, continue to test operational resilience and crisis response. And if there's any vulnerabilities identified with third-party service providers, ASIC is expecting that those are addressed as soon as possible to make sure that incidents and other breaches don't arise going forward. So we might move to the next slide, because I think that might dovetail nicely, Tetiana, unless you had any comments from an industry perspective, but I think it links in quite well to APRA CPS 230. Sorry, are you still on mute? I think
You're on mute, Tatiana.
Sorry. Before we move to CPS 230, I just wanted to stress out, when we work with people on their obligations, ASIC does not have any specific obligations that have to do with cybersecurity or technology or AI or anything like that. So what a lot of AFSL holders do, then they kind of assume that, it's not required, but it's not true. As you can see, whilst it's not required in the sense of having it in your obligations register, it's very much an area of interest for ASIC. And the way we would practically address these things, we would practically address them through the risk register. So when we speak about data and security and so on, this is where this whole argument comes into play. And I would say a good thing for any AFSL holder is, unlike compliance, risk is a framework that you can set up yourself, right? And you can define your own appetite. It's not mandatory kind of given to you. So that's why I would say it's a good reminder that whilst there's no black and white AI regulation or a regulation on cybersecurity, this is very much a regulatory focus. All right. So just very briefly on CPS 230, Yvonne, did you want to walk through? I'll just walk through. So maybe...
Yeah. Do you want me? I can do a recap. Sorry.
Yeah, just do a recap and I'll just speak about what we are observing. Yeah.
No problem. Yeah. So many of you will be aware of CPS 230. We've run some webinars on this in more detail last year, but also there's been a lot of industry engagement on these requirements because it came in from the 1st of July last year for APRA regulated insurers and reinsurers. And it's really designed to make sure they stay resilient to operational risks and disruptions. And importantly, they manage risks arising from use of service providers. So the nature of the insurance market means that a lot of material service providers who are identified by APRA regulated insurers will be indirectly impacted by the CPS 230 requirements because those will get pushed through to material service providers through contracts and other mechanisms to make sure that the APRA regulated insurers can meet those requirements that are now imposed through the Prudential Standard. It replaces a couple of existing Prudential Standards, CPS 231 outsourcing and CPS 232 business continuity, and it has required insurers to go through and identify things that are considered to be critical operations and any material service providers, as well as setting tolerance levels for disruptions to those critical operations. So if we go to the concept of who is a material service provider, that's quite key and quite, I think, important for this particular audience. It's any provider that the insurer relies on to undertake a critical operation or who exposes the insurer to a material operational risk. So at a minimum, certain types of providers who support on underwriting, claims management, if they have meet that level of materiality, they will be considered to be material service providers to the insurer. It's up to the insurer to work through that process of identifying who falls within the category of material service provider. But once you are caught, then there will be questions that come from APRA regulated insurers because they need to maintain a material service provider register that they submit to APRA annually. They need to make sure they have a material service provider management policy, which identifies how they will classify particular material service providers and manage arrangements with them. And then lastly, they also need to make sure you have a formal legally binding arrangement that meets the minimum content requirements that are set out in CPS 230. And that's really where we're seeing a lot of the activity at the moment in relation to interaction between APRA regulated insurers and any material service providers who are supporting those insurers, where there's now a lot of negotiations around what the terms of any service provider arrangements should include. So we won't go through all the content requirements in this webinar, but it's important to note that it captures things like where the material service provider uses a fourth party, so someone that the material service provider relies on themselves to deliver the service to the APRA regulated insurer. If you are using a fourth party, there is a requirement to notify that the insurer that you are using the fourth party in that context, and that will then be built into your contract as part of those negotiations. There is a transition phase available to insurers who have existing contractual arrangements with service providers. So those CPS 230 requirements will only apply in relation to those arrangements from the early of the next contract renewal date or the 1st of July 2026. So that's, I think, why we're seeing a lot of that activity happening now, because we are fast approaching the middle of the year and a lot of contracts might already be due for renewal before that date in any event. Tetiana, over to you.
Yeah, so on the practical side, I guess in the last 2 years coming up to CPS 230, we saw a lot of contractual activity, still, as Yvonne's saying, going on for the next 5 months. But for those who have their contract negotiations behind them, what we're seeing is almost like the work is starting now. So a lot of people are increasingly investing into IT infrastructure and cybersecurity. Even those entities who are not necessarily directly regulated by APRA or are not tech providers, they're looking at all kinds of certifications and hiring all kinds of help to, almost like run a certification-like process. I mean, in terms of IT infrastructure and cybersecurity. Then a lot of work is happening on outsourcing arrangement and oversight frameworks. So those who are relying on external third parties and fourth parties, their obligation in the eyes of APRA regulated insurers is to prove that they have a good, well, first of all, due diligence on that company, but then that they've got a good oversight framework. then the very much kind of following from it, business continuity plans. Those are now being actively rewritten and tested to make sure that the communications lines are open and plan B, C, and so on are actually workable and not just something on paper. As Yvonne said, a widespread contractual changes everywhere. It's kind of cascading from insurer to to their material service providers and then down to the fourth parties. We're at that stage now. The ripple effect is real and happening. And finally, it kind of did happen last year, but now the enhancements to risk and compliance framework, specifically by MGAs and material service providers, is very much actively happening, because now, people have signed those contracts and now they're like, okay, so what does it actually mean for me? And how do I really make it happen? So all of that work is on the way. All right, let's move on to the industry code updates. So as Yvonne was saying, we do not kind of expect too much legislative change this year. At least we're not aware of any big ticket items coming, and neither big announced kind of things from APRA or ASIC. However, it's almost like a year of code updates. Like all of them are currently being reviewed and in various stages of how far they are to be finalized. So let's start with the GICOP, General Insurance Code of Practice. So it's been in the review last year, almost the entirety of last year. There are two kind of drivers for it. One is a very kind of normal, scheduled, regular process, which is an independent con review. You need to review it every few years to make sure it's up to date and addresses kind of the real existing problems in the insurance industry. And the other one was a slightly extraordinary one, which was the flood inquiry. So the Royal Commission into the floods of 2022. And following both of them, there were many, many different suggestions to the ICA to have a look at, plus to various industry groups to comment on, and obviously the insurers to respond. We've summarized big themes for those suggestions. Obviously, this is not the entire list, and also at the moment, this is our latest understanding of what ICA is thinking about. There's at the moment no clarity of what's actually going to be in the code. So just to give you a little bit of an insight, Yvonne mentioned earlier there's an update on how ASIC is going to work with industry bodies to approve the code. So this is exactly what's happening now. ASIC is working with ICA to see how this code can be approved and embedded. And the very, very big change that the code is suggesting this year, and I'll pass on to Yvonne to explain exactly what that means. For the first time in insurance industry, the GICOP is going to be contractually enforceable. So up until now, it was not. It was a recommendation on the side, and the PDS documents and other your typical disclosures had to refer to it, but it was never part of the contract. Now the suggestion is it becomes contractually enforceable. And Yvonne, if you can just explain to us what that means.
Yes, thanks, Tetiana. So yes, contractually enforceable, it will be a big development. In effect, what it means is that the code obligations that code subscribers will sign up to, they will become embedded directly into insurance contracts with consumers. And that means that those consumers can pursue contractual remedies against the insurer or the code signatory in that case, related to those code obligations, which sat outside in the past as code obligations that were voluntary for subscribers to deal with the ICA and the Code Compliance Committee separately. So as an example of where this type of approach is already being used in the financial services ecosystem in Australia, the Australian Banking Association Banking Code of Practice is contractually enforceable. And what that means is that it operates by having those code obligations incorporated into the terms and conditions of banking services and loan agreements. So when a bank subscribes to the Banking Code of Practice, those provisions become part of the legal contract between the bank and their customer. So if the bank breaches a code provision, the customer can raise a complaint directly with the bank or with AFCO. There can be enforcement action taken through the Banking Association's Code Compliance Committee as well. So it's just an example of how this type of approach is becoming more prevalent in the industry, and that just links back into ASIC's expectations when they are approving enforceable codes of conduct. That's the expectation, that they're seeing ways that consumers can enforce those code obligations directly against code subscribers.
Yeah, so as you can see, this one change will actually trigger quite a bit of work for the industry. We'll come back to that later, but just for your information. Then the next big theme is about plain language and customer rights. Just make it as easy as possible for customers to understand exactly what they are entitled to. Then the next one, expert report best practice standard. So throughout the floods of 2022 and also throughout the regular review, this theme has been singled out by a lot of people, saying that the quality of expert reports often varies, and this is what insurers are using to make determinations on claims. And when they cannot deduct exactly what happened, or when it's not described well, and when the customer doesn't understand what the report says, it actually poses a big problem, right? So it kind of makes a decision, and a fair decision on a claim, very difficult, even for the insurers. So that's why they're trying to fix that. Then extreme weather and disaster response charter. So effectively, ICA has been publishing materials about that before. The idea is, so when extreme weather events strikes, that the industry is better prepared. It's got mechanisms in place to react quickly to support the communities that have been impacted. Vulnerable customer framework, we've been talking about it for many years now. The current kind of challenge with it is that even though the definitions have been extended in the current code, a lot of people are still not familiar with what a vulnerable customer is. Often those definitions might not necessarily serve the purpose. And it was one of these areas that are kind of, when it comes to practice, was probably not well thought through, and a lot of people felt like it might not be the most adequate one. So I'm personally looking forward to see how they will suggest to improve it. We'll see. Then standard definition for home maintenance and wear and tear. So again, it comes from claims and complaints and, dissatisfaction of customers of what was classified as wear and tear kind of post factum. So introducing standard definitions and not relying on insurer-specific ones is the suggestion here. And finally, it's a new one, completely new one, internal consumer advocates. So the suggestion is for insurers to hire people who would be working for an insurer, but representing the customer in the matter of claims. So again, I'm very much looking forward to see how this is going to play out. In terms of timeliness, the code and the ICA is currently working together with ASIC, how to put this forward, what to do with this, and how especially to work on that contractual enforceability. The estimates that we've heard from ICA say that the code is not likely to move anywhere in the next 6 months, and we will expect an update in the second half of 2026 on what's going to happen with it. All right, let's move to the broker code, the insurance, the IBCCC committee and the broker code of practice. So the broker code of practice, the recent one is from 2022. And in the current process, it needs to be reviewed every 3 years. So the review of the code happened last year through an independent company who formulated 14 different recommendations and put them forward to NIBA to have a look at them. So this is all of those 14 recommendations kind of very, very briefly listed in here. And what we've added, and that came I think 2 days ago, NIBA responded to those recommendations. And effectively, we put just a little summary for you here, what they say. But NIBA effectively said that it agrees with some and then has suggested an alternative mechanism of tackling some other ones. I'll just walk you briefly through the main themes. So the independent commission has suggested, for example, to recast the code as promises to clients. And NIBA said, we're probably not going to do this. However, we commit to rewriting it in plain English and just use simpler terminology and make it clearer for the clients what to expect. Then make code contractually enforceable. So NIBA has rejected this proposal. So we've just heard that the JICOP is moving towards that area, but NIBA is not, at least that's their position at the moment. Extend disclosures to all individual businesses and small businesses. So that has to do with, a lot of it is about remuneration disclosures. If you've been following the debates over the last year, and even when the code, the 2022 version was being discussed, you remember that was this remuneration clause, I think it was 6.1, that got delayed by a year because it causes a lot of, first of all, operational burden on brokers, but then obviously a lot of different debates about it. I'm not going to go into those. So the extension, it's everyone's aligned that more disclosure in remuneration is absolutely necessary. It still remains to see how much and where, to be honest. We will see where it lands at the very end. IBCCC to investigate disclosure practices. Again, NIBA came back and said they will probably address it rather in the IBCCC charter than in the code itself. Then there was a suggestion to introduce mandatory disclosure templates, but NIBA believes that it's potentially very onerous and there are quite a lot of those. So they'll be looking at this. Then consolidate conflict of interest provisions and effectively align them with that code that we referred to before. Sorry, the regulatory guidance from ASIC, the 10181. So that's in here. Yes, it's going to be aligned, the expectation to brokers to the ASIC guide. Then investigate conflict management. Again, the issue was pushed to the IBCCC charter rather than to the code. Update vulnerability provisions. Yes, I'm personally kind of looking forward to see how those will be aligned across different codes, because obviously you're dealing with exactly the same customer, just from different angles. Then import a standard number 9 for financial advisors. It's about advice standard applicable to them. And I think NIBA has not adopted it 100%, and it says it's actually addressed in other things. So it's not a support without any further investigation on this. Then investigate personal versus general advice. And again, NIBA says it's probably not, code is not the place to do that, but it's more the place in the IBCCC charter. Increase the renewal period, or the obligation for the broker to contact the customer, from 14 days to 28 days. And if you are familiar with this, but a lot of brokers already actually had the 28 or even 30 or whatever. They had higher internal standards than the code standard of 14 days for renewals. So it's probably not far off a lot of practices that were already in place before this. Explicit record keeping obligations. So this one's an interesting one, because when we are working with a lot of breaches, a lot of the times it was very hard to kind of pinpoint in the code what exactly is the breach about, because if the broker did not make a record of, for example, an explicit client request and missed something accordingly, it was very hard to pinpoint in the code where exactly is that not applicable, or what exactly was breached here. So I guess it's just a clarification point here. Then mandate annual IBCCC inquiries. Again, NIBA board said they would rather address it in the charter than in the code, and adopt a 5-year review cycle rather than a 3-year one. So there's absolute support for that, not to do it so often. All right, so the process from now onwards is what I've listed for you is the recommendations that were made, then the NIBA response to them, and what's happening from now onwards. There'll be another period of consultation, first with the industry, the brokers themselves, plus with consumer advocates and wider public on if that's an acceptable new version of the code. Again, nothing is going to happen anytime soon. We're not expecting, definitely not this quarter, potentially some movement next quarter on this to see where NIBA is landing with this. All right, life insurance code.
Thanks, Tetiana. So this is the last of the 3 codes, industry codes, that is undergoing review. The process is a little bit behind the other 2 codes. So it is being overseen by, it's an independent review that's being overseen by former ASIC Deputy Chair Peter Kell. There was a consultation paper that was issued in October last year, and submissions were open until the middle of December. So that's only just closed. They're now considering certain submissions on the key themes that we've got on the slide there, which really relate to clarity and effectiveness of the code's commitments as they currently stand to consumers, adequacy of support for vulnerable customers, the quality of insurer communications, particularly during the claims process, and the monitoring and enforcement of compliance with the code. So all very similar themes to those that we're already seeing happening in the General Insurance Code of Practice Review and Update, and also the Broker Code updates as well. Specifically to the sector, there's also consideration around blanket mental health exclusions and how that might interplay with the Disability Discrimination Act. There was a recent Life Code Compliance Committee report on mental health that was issued in September 2025, which has been quite influential on that issue. So we will see that continue to evolve through this consultation process and review. And then the piece around enforceability of the code. I think this one could be quite a big decision for the life sector. Unlike the General Insurance Code of Practice, which I think has been confirmed will be contractually enforceable, this is still being considered in the life insurance sector as to whether that is appropriate in the context of the intent of the code, which is really to be accessible easily and to allow insurers to have room for creativity and flexibility in how they achieve those best consumer outcomes. So it might depend on how CALI, as the industry body, will respond to any submissions in that space around enforceability and the recommendations that come from the independent review. There's also a focus on improving identification of and support for First Nations customers, and also enhancing staff training to make sure that there's an understanding of various cultural practices. And this has been also influenced by a recent LCCC report on supporting Aboriginal and Torres Strait Islander customers, which was issued in November 2025. Now, submissions on the consultation paper closed in mid-December, as I mentioned. So all the feedback that has been submitted by life insurers, any consumer organisations, regulators and other stakeholders are going to inform the preparation of an interim report, which is due in early 2026. And again, it will be subject to further consultation. And after that, there will be a final report that will be delivered to CALI as the industry body and the code that is due by the 30th of June this year. So this is another evolving area. So those who are in the life insurance space, the outcomes of this review might influence any expectations around your product governance frameworks, distribution oversight, the treatment of the vulnerable customers and the processes you have in place to support that, as well as training and your claims processes in general. So there's a lot to focus on that can come out of these various code updates and reviews. And yeah, that those will become a lot clearer towards the middle of this year. Back to you, Tetiana.
So we've summarized, again, a few themes here based on the proposed changes, and we kind of separated insurers, MGAs, and brokers to see what is likely to change and how, like internally, what would that mean for them. So at least on the JICOP, the confirmed intention to have code contractually enforceable will trigger review of policy wordings. So it's kind of, you're looking in the future where lots and lots of PDSs and policy wordings will have to be rewritten. I think it's a very, very big kind of chunk of work, and it will impact absolutely everyone in the industry. So just kind of warning you, potentially this is one of those things that will happen. Then absolute focus on claims handling, on standards of claims handling, communication, timeliness, decisions, transparency, fairness, well-documented claims practices. I mean, claims handling has been in the press and also in, front of ASIC's attention for many, many months now. And unfortunately, it's still a theme, because the regulators and the public is not satisfied how claims are handled at the moment. So that absolutely stays and will be the area of focus. Then an interesting shift from compliance assurance for a lot of the code, when risk and compliance functions oversee the compliance, they usually treat code breaches as a separate compliance issue, but now it becomes a contractual risk management. So it's a very big shift also internally and different lens on how you actually run the enforcement of those things on a day-to-day basis. External reporting standards, absolutely, we've discussed that already. Extreme weather and disaster response planning. So planning is what people will have to do a lot more, not just response, but actually planning of the response. And I guess a higher focus on their catastrophe planning and resourcing and, training and how they're going to extend their capacity during those events. Then the big one is customer vulnerability. So first of all, yes, the framework is going to be enhanced and potentially increased, but then how are you actually putting it into the process? How do you make it as a business as usual? And in our experience, that has been a really, really hard one. We've seen a lot of people struggling with this. And finally, staffing and carving out the role of a consumer advocate in claims and how that's going to play with other scenarios. Because on one side, you already have, let's say, if a customer is represented by a broker, you already have, a consumer advocate on that side. So it's just going to be interesting to see how the role is going to shape up. But this is what insurers have or are already thinking about. For brokers, so broader remuneration disclosures are coming. And for a lot of brokers out there, it will actually require proper change to their operations and technology. It's absolutely key. You can't, disclose something if you don't know what it is and where to find it, and you can't make it like an easy process. So that's definitely will trigger quite a few operational technology reviews. Then definitely review of conflict of interest, partly driven by this RG 181, which is already issued and already there, and obviously the intention of the broker code to put it into the code, so to reinforce it. Then investment in staff training in relation to customer vulnerability, for sure. As I said, it's one of those areas that, at least in our view, has not been implemented well. Higher record keeping requirements, so more discipline around what you know about your customers and how have you documented it, and potentially that could trigger reviews of some of the technology and the process that's being used. And finally, longer code review will actually allow IBCCC to focus more on trends rather than go into each individual breaches and have a good, view of what's going on in the industry. Now, these are some very practical things that we thought of that are kind of safe to do today without having the full information of, what exactly the code are going to deliver and how exactly the final wording is going to land. But definitely review claims handling processes, policies, and weaknesses. If you focus on weaknesses, you'll be well served, because weaknesses is what kind of led us into this. And if you know what they are, and if you've been putting it off, it's probably a good time to start looking at them. Then review the most frequent complaint reasons and look at the root causes. Again, not most, but a lot of the complaints are happening in claims or related to claims or decision or handling. And if you start looking at what they are and almost like analyze, map out your own strengths and weaknesses, complaints is a great source of data and understanding. Then test system for potential operational changes. And that applies both to insurers, MGAs, and brokers. So already that some things will change. So let's say for brokers, the extension from 14 renewal days ahead of the renewal to 28. Can your system support that? Do you have automatic reminders that can just easily be adjusted? Again, for brokers, if you've got big obligation for remuneration disclosure, can you pull those numbers in from somewhere? Is it realistic? For insurers, it's a little bit trickier to see what exactly the changes will be. Then make sure that you track the timelines and start preparing for the changes early. The good thing about the codes, all organizations are pretty transparent in what's going to happen, and they give you, warning. The difference would be, let's say, with those ASIC regulatory guides that we talked about before, we actually have no idea when they're going to drop. And so we're almost like waiting for them any day without knowing if it's going to be this month, next month, and so on. And this makes, compliance and planning ahead slightly more difficult. But with those, you actually have good foresight. Then yes, review your conflict of interest practices and align them to RG 101. We said that one is already out. That one is the most up to date. And we do not believe that any code or any other practice will actually steer you away from that. So it's a pretty safe bet to work on it now. And yes, start working in your vulnerability frameworks and employee education. I think it's a no-brainer. Again, it doesn't really matter how the framework is going to look like at the end, but gradual education and just more focus on this is kind of a safe bet. All right, that's more or less it in terms of our prepared content for today. So we've got 2 minutes. Let me see if we have any questions in the chat. There was a question. Can you please provide links to this ASIC guidelines, or are they available online? They're all available online, but we're happy to send them to you if you want to. Any other questions? I'm seeing people from meeting rooms. Yes. So yes, please send us your email addresses if you're joining from, because we need to allocate you to the record of your registration to be able to issue a certificate for you. So just make sure we're not missing out, and don't consider you as no show, but rather as a person just joined from another account. Yes, John, we'll send you a copy of the slide deck. All right. If there are no more questions, we'll give you the whole entire minute back in your day. And next webinars are going to speak about privacy and ASIC regulatory guides. So keep an eye out for this. Thank you so much.
Thanks, everyone.
Bye-bye.
Good rest of the day.